thank you very much to everybody that has joined the call today. I suppose good morning, good afternoon, good evening. We've got people from various parts of the world on, so very much appreciate your time. So obviously, it's no secret. It's clear that you only have to you only have to look at the you only have to look at the headlines to realise that we're not perhaps in the property market, the economic sort of cycle that we were in, say, a year or two ago. And so it's something that we talk a lot inevitably about in the office, right, Elliot? So we run these webinars monthly, various different topics, bit of a market update. But the key today really is we're just going to talk about, how ultimately what strategies that buyers can employ, what strategies buyers can use to actually do well in what is, let's be honest, a little bit of a challenging market.
Yeah, exactly. And I think that sort of a really key point to sort of realize with us doing these monthly webinars and that sort of things is that the conversations and the topics that we discuss and come up, these are coming up on a 3 or 4 times a day, 5 or 10 times a week sort of thing. So it's really important for us to be able to express what's going across our desks and what's happening at the sort of coal face, if you like, what we're seeing on a day-to-day basis that's going on in the property market, and hopefully trying to sort of give all our clients as a clearer picture as sort of we can from the information that we receive and what we physically see happening in the market, as it stands, live, if you like.
Yeah, absolutely. And which is why we're looking to run these obviously on a monthly basis. Just to introduce myself for those of you that don't know me, my name's Richard Bradstock. I'm the MD of the RPA Group, and obviously Elliot, our Associate Director here in the Middle East. We've both been involved in property for a long time. I think it's fair to say, Elliot, right? 20 years, give or take, for both of us.
Yeah, so, absolutely. Mid-2000s.
Grey hair gives it away on my part, I think. But so today we're briefly going to talk about, as you would have seen from the invite, we're going to talk a little bit about how much money is, on a typical buy-to-let investment property. What does that actually look like? What does the, what does that represent? Interest rates, as is well documented, are a 15-year high. How does that affect the returns? How does that affect the essential investment into buy-to-let property? We're going to look at different asset classes, and because I think the key with buy-to-let investment at the moment is that actually there are 1 or 2 slightly alternative things that you can do that actually would work exceptionally well. We've got 3 new launches over the next few weeks. We're going to sneak peek at those, and then just to round off, just in terms of how we can help you from our side. So moving on, I think, Elliot, perhaps if I could, I'm going too far through the presentation there. Maybe hand over to you to talk a little bit about this bit, but this is news actually out yesterday.
Thank you. Yeah, so as I mentioned earlier, it's just trying to give everyone a sort of clear picture of what we're seeing as live as we possibly can. So this Zoopla report that came out yesterday, actually, when you're looking at it from a house price perspective, it's not quite the sort of disastrous market that you might be perceived in certain headlines and things that you're reading. In a worst case scenario, you're just under parity in terms of house price growth for the year, which is obviously all considering actually not that bad a position to be in. But key from a key perspective is that actually a lot of the city centre locations, or a lot of the locations where we felt from our own due diligence and own sort of sourcing of products that prices are holding. What you generally see in house prices, obviously when we're looking at it from a national perspective, is that that there will be areas that are strong and have strong demand, and infrastructure's been there and everything else like that, which means that sort of house prices hold. But then you obviously have areas that will be a little bit more volatile, and sort of coming out of sort of COVID and the last couple of years, where we saw sort of the race for space and people leaving city centres and looking to maybe move to areas where had a bit more outdoor space, or sort of a garden and that side of things, and working from home, and sort of the world and everything sort of changing maybe back into more of a traditional way of working. People are going back towards city centres, and so that demand is sort of ever increasing. The
I think
most
also, sorry, Ed, to interrupt there. I mean, I think it's also worth referencing that, clearly there have been, on average across the UK as a whole, wider price drops. So we're not sitting here kind of head in the sand, as it were, shouting, no, the market's fine. But what is interesting, that if you are in the city centres and you are in places where there are clearly defined supply and demand deficits, that prices are holding or even slightly growing in certain parts of the country. So you're going to hear us say this a lot on this webinar, I suspect, but that location is everything. If you are going to buy something, you need to make sure what you're buying is a truly sort of excellent location and a very good product, and then you will be protected, and will actually, over the sort of short to medium term, I still expect to see some a little bit of value appreciation.
Yeah,
that's you, Elliot. Sorry.
And then sort of on the flip side of the house price growth, and a lot of our clients on the call today, and the clients that we're obviously dealing with on a day-to-day basis, the reason you're talking to us is that 95% of you are looking for an investment property rather than something to live in, and actually rents in the UK are at an all-time high. So what we're seeing now is that supply and demand is becoming even more apparent in the rental sector, which is driving rent. So more and more people looking to rent in these sort of key locations, and prices are at an all-time high. So in London, the average monthly rent now reached just over £2,000, and within the UK itself, on average we're at just over £1,200 a month. So there is from an investment perspective, and when we're looking at the yields and that side of things, there is a significant increase in that over the sort of last 6 to 12 months. Which is really important, just to put things into perspective, and to look at things, from a sort of an eagle eye view, really, rather than maybe some of the sort of more negative press you may read. House prices are holding, essentially. We're not seeing huge growth, but absolutely no. And there are areas that are probably seeing, a bit more negative growth, but we are seeing strong rental returns. So it's just weighing those two things up.
And I think this is, and when you're considering whatever investment it is, whatever asset class it is, you obviously need to work out what you're trying to achieve. And so if you're looking, for example, if income is a major factor in terms of what you're looking to achieve, then there's actually arguably never been a better time, because prices haven't particularly gone up over the last 12 months. The rents have shot up dramatically, and we'll come back to this in London, particularly on a later slide. But from an income perspective, it's really quite sort of unparalleled, actually, the sort of level of income and yields that can be achieved out there in the market. So let's move on now, and let's talk a little bit about one of the questions we set out to answer is, for a typical UK purchase, how much money is required? So obviously this comes with certain sort of assumptions, but perhaps you could talk us through this.
Yeah, absolutely. So so on that, again, a question that was sort of asked all the time, I thought I'd just use an example project that we have had in Birmingham, which has actually now sold out. The average property price for the RPA group sort of sales price over the last sort of 12 months is circa £290,000. So in this instance, for this example, I've used a 2-bedroom in central Birmingham, and the purchase price is £310,000. Now, again, this is specifically sort of from our perspective. We're always looking at, say, city centre locations or areas within the country that we're seeing that growth, and in areas like Birmingham city centre, we know that it's a really very solid and popular investment area. So this is a real medium example. We do have projects for £150,000. We do have projects up to units up to 2 million or something. So this is in that middle ground really, and the most popular. So in this instance, when you're looking at sort of a 2-bedroom apartment, which is going to be about 800 square feet, all in total costs, you're looking at around £140,000. Now these are headline figures. So that is on the basis that you would be having a mortgage. Your mortgage sort of deposit would be 35%, and then so the total investment, as I say, is just shy of £140,000. That is also including all taxes, associated costs, whether it be from a lending perspective or from a lawyer, legal fees and associated costs, and from that side of things. But all in, £140,000. It's good to use these sort of headline figures. Sorry, Richard. Yeah, it's good to use these sort of headline figures. As I say, there are units that are cheaper, and obviously will be sort of almost half the amount of total investment, and obviously there's projects and units that are more expensive and will be double, triple the amount. So just it gives you really a good idea of sort of total cash investment of around £140,000.
I think something just to stress here as well is that obviously this is one of those questions we get asked all the time, right? And so we just wanted to show you an illustration, very, very high level illustration of the cost. When we are, as the RPA group, whenever we are helping someone purchase a property, we have a very detailed cash flow analysis document, which will ultimately give you, we can do it by unit, we can change the amount of borrowing, we can change the interest rates, we can change every little last bit of it, so that to the best of our ability, we can give you a very detailed cost analysis of what it takes to go into the property. Now, one thing that's quite important to mention here as well is that another question sort of related to this that we get asked all the time is, should we buy off plan or ready property? Because, and this is in this particular example, it's quite relevant a question to ask, because this is something that actually is off plan, and so that means that we would be asking for the exchange deposit and reservation fee now, and the balance on completion. So this enables you to get into the market, fix a price point in the market, choose a good unit, and ultimately, put in, secure a position whilst putting in less than the full amount. So in this particular example, roughly £64,000 of that would have been required, say, if you said, yeah, I want to buy something today, in about 4 to 5 weeks. And then in this example, 18 months down the line, you would then be asked to come up with the rest of the completion fund. So what this enables you to do as an investor is obviously manage your cash flows, stagger the payments. It enables you to gain access to a product, when nobody else has had access to it effectively to choose the best units, all those sorts of things. And in theory, by the time it comes around to completion, it should then be worth a little bit more money. I think as well, the other thing that's very sort of topical, of course, that we've already mentioned is interest rates. And there is an expectation, Elliot, we were talking just about this just before, there are some people now calling sort of where we are with the base rate and interest rates as essentially probably as high, more or less, give or take, as it's going to go. Over an 18-month build period, as inflation in the UK is brought under control, we would expect that those interest rates to continue to come down a little bit, and we're actually already seeing the first signs of that. NatWest, HSBC, one or two others over the last week or two have all announced interest rate cuts on their mortgages. So there is actually a very, very logical investment argument to be buying off plan now and organising your mortgage in 18, 24 months time or whatever that might be. So in this example, that would be the 64,000 pounds now and the balance on handover later, where in theory, if the various sort of economists out there can believe that interest rates should be lower, and that logically that is where it should be going.
Yeah, exactly. And with the market of sort of certainly the last 12 months not necessarily seeing significant growth from a price perspective, simply going back to the supply and demand sort of point within the UK, rates will start to drop, and you will start to see house prices increase where more people are able to enter the market again.
Yeah.
Now, another sort of question that sort of is asked very regularly is with regards to where we're at with interest rates, was Richard just touched on then. We are at sort of a 15-year high in terms of what a typical buy-to-let, the interest rates are on a typical buy-to-let mortgage. Before I sort of go into the detail and using the same property as an example, I really do think it's worthwhile sort of looking at the bigger picture. And when we look at sort of interest rates, the average interest rate between 1995 and 2023 was 5.64%. So the average interest rate at the moment in the UK is 6.66. So, albeit it is higher, it's not significantly higher than sort of the average over the last 30 years, which I think it is really quite important to sort of recognise. And ultimately, when we're looking at this from an investment perspective, and buying a property 30 years ago and going through that time period, or building a portfolio over that time, you generated and created significant wealth from doing that. And the interest rates will move, but so will prices, and so will the rental amounts, and the demand will continue to move on. So looking at this particular project again, so this is on the left hand side here. We've got the projected cash flow. So this is still my 2-bedroom property in Birmingham. So a 6.6% interest rate I used on the cash flow. You would, a very high level perspective, you'd still be looking at a net cash positive position of £126 a week.
I presume this is interest only on this. This is interest only.
Sorry, yes, this is on an interest only basis. Yeah, sorry. Yeah. So this is on the basis that you will be achieving £1,400 a month from a rental perspective, which we certainly in this instance we know is. I mean,
I actually think that's quite conservative, isn't it? I mean, we know the most recent 2 beds that this is sort of priced up, because this is a project that we've finished selling a month or two ago now. Sold that a month or two ago. These were done priced up about 7-8 months ago. I mean, the most recent 2 beds within the Jewellery Quarter that we've let have been closer to 1,500. So yeah.
So yeah, exactly. So on that conservative basis, we're still net cash positive from month 1, and then year 1 you're looking at about £1,500 with the current rates as they are today. As Richard just previously mentioned, and from sort of last week or so, really, we're starting to see a change in terms of the interest rates from these big lenders. Swap rates are reducing. And so that lenders feel like that we're hitting sort of the peak in terms of where interest rates are from the base rates perspective, and are starting to act accordingly, and basically generate more business again, because it has been quieter and people have sort of stood off for a while. Now, when we are looking at this, we looked at short term, we're looking at over the next 12 months, and we know we're sort of cash positive. But then the interesting part is to look at this, and we would only ever recommend anyone, if they're looking at investing in property, to look at a, sort of an absolute bare minimum of 5 years, but really a minimum of sort of 10 years ideally, really, because every 10 to 15 years house prices double in the UK. Now, when we look at that total investment of £140,000, after 5 years, the ROI of that investment is going to sit around 36%. So 36, and after 10 years, we're looking at best part of 100%, 98.8%. And that's for that investment of £140,000. Will generate these returns, that return on investment, over a 5 and a 10-year period.
And I think it's also worth mentioning that the growth numbers and so on that we factor in, and for anybody that's interested to see how these numbers are arrived at, we are more than happy. You know, we're more than happy to sort of take you through them on a one-on-one basis to show you exactly the numbers involved. But the growth numbers in both rents and capital values over a 5-10 period that are assumed are deliberately conservative. The idea being to show that even in a less sort of a less than positive scenario, actually this is why property still works. This is why people continue to buy it and invest in it, because ultimately, actually the sort of the growth that we would expect to see over 10 years is some way above what we're quoting in these cash flows, which generate these numbers, which at the risk levels is obviously pretty exceptional.
Exactly. And certainly looking at the UK market in particular, when we sort of look at sort of records over the last 50 years, we've only seen 7 years of negative house price growth in a 50-year period, and they're not consecutive. They weren't 7 consecutive years, but 2 of those 7 years were only in double digits. All the rest were sort of maybe 1%, 2%, 1.5%. So we've got significant evidence to support the market, really, and the long-term sort of case, really.
Yeah, I mean, look, on a very basic level, we've seen, I mean, since you and I started working in property, Elliot, back in London, many years ago in the early sort of 2000s, in that period, if you just look at it from a really high level, in that period, we've seen, the GFC, the biggest economic sort of global crisis, since the 20s. We've seen the 1920s. We're in the 2020s now, aren't we? 1920s, I should say. We've seen Brexit votes. We've seen COVID. We're obviously in a period of sort of inflationary pressure and so on now. But the one thing that happens again and again and again, regardless of what's happened in the wider markets, is that you look at house prices 2-3 years down the line and they're up. And that's the bottom line. So it's there's so having been in the market so long and seen what feel like major sort of perturbations of the market, I firmly believe that in moving forward we're going to be in a very good place. So just to talk a little bit about locations and the types of opportunity where we see value. So just to start with London, because it is the one that people often start with, being obviously the world famous city that it is. So we're in a period of opportunity, I feel, in London, which might seem like a sort of counterintuitive thing to say given everything I've said, or everything that you read in the market, not so much hopefully what I've said. But the UK since 2016 has seen a 32% house rise, 32% house price rise, I should say, whereas London has only seen 12%. Across the UK, we've seen rental price growth of a significant number, across that period. But in the last couple of years, we've seen dramatic rental growth, as we saw from that first slide, in London in particular. So it used to be that if you were buying property from a yield perspective, you wanted a really solid sort of 5-6% income, you would have to go to Manchester or to Birmingham, or a regional market where these sort of yields are available. In actual fact, you can now be in Greater London. You can be 20 minutes from, the City of London, and be paying £2,000 a month rent on a £400,000 property, and so which essentially works out as 6 or even above 6% if you're in the right locations. So London, in my view, is back in that sense. Now we haven't seen much. We've actually seen slight price declines in London, but there again, in my view, lies the opportunity. So if you are someone that is looking for a slightly higher value, investment than we talked about just now, £290,000, £300,000. If you're looking at £400,000, £500,000, £600,000, there is opportunity there to go and get a really strong yielding asset in a location that ultimately, and very simply, because it's London, it's never going to go anywhere. It's the biggest city in the UK. You've got the biggest sort of supply and demand deficit. So rents will hold and likely go up significantly over the coming 5 years. And I think what we're going to see from a value, sort of capital value point of view, is perhaps not for another 12 months or so, but once we see interest rates drop even slightly, once perhaps the average comes into the 5s, then I think we'll see some significant growth.
Yeah, and sorry, Rich, just to add to that point and to put this in a bit of perspective. So, look, a 6% rental yield on a property in London. So I was working in the London market since 2006, so sort of a good 12, 14-year period of being based in London. If we were ever putting sort of forward opportunity to clients with anything north of 3% as a rental yield, it was a fantastic investment. Yeah. So we're almost doubling up on that now, which really puts it into perspective and just outlines the opportunity that's there. And which, as Richard sort of rightly says, that has maybe been bypassed in recent times because of the fantastic opportunities that we're finding in places like Birmingham, like Manchester, and other regional cities.
Yeah. So moving on, something that you don't necessarily see much talked about in the investor world, but is the single family home market, or otherwise known as a posh phrase for houses. These are houses in sort of commuter belt locations to larger towns. It tends to be a different type of tenant. It tends to be older family, people who are looking for a bit of garden. There's very, very strong mortgage availability on these types of assets. And actually, from a growth perspective, we're seeing institutional buyers buy the single family home market in a much bigger way than we ever did before, which is further putting constriction on supply. So this is pension funds and so on who are buying up houses to rent them out as an income stream. So this sort of thing never really happened in this market before. And so if you can buy a really good 2-3 bed house in a market town, close proximity to a major centre of employment, this is something that is going to do exceptionally well from a growth perspective moving forward. You will probably achieve higher income percentages through city centre flats, for example, but the growth on this type of asset from the capital value point of view is expected to be higher than anything else. Then the other thing, of course, that we're being asked for all the time, and it's more important than ever, is obviously income. Clearly, the higher interest rates have really affected people's cash flow positions. I know just on my own sort of investment property I have in the UK, my mortgages have doubled effectively in the last 12 months. Now, fortunately, the rents have gone up significantly. I mean, almost doubled in their own right. And so from that perspective, there is an element of protection. However, there are, if you're looking for a real estate asset that perhaps could offset, for example, your costs on another mortgage that you might have on another property, buying a cheaper asset, perhaps in the short lets market, something like that, which will give you a very strong, very high yielding income stream, is something that people should look at, and something that we are actually, as we'll talk about in a minute, will be launching in the next sort of 2 or 3 weeks. And then ultimately, we've already really talked about this, but Birmingham and Manchester, and Leeds I'll throw in there as well. The major cities city centres, still with relatively affordable price points. I do think somewhere like Manchester now, you're probably looking at outside of the equivalent of Zone 1 Manchester, you know, because you're talking about some pretty big numbers, but there is still some really excellent affordable assets there with really strong rental yields as well. So the key here, as with anything, is to make sure that whatever you're looking at, is it works for you. You know, we need, and this is where RPA can help. You know, what we always are trying to do is understand what you're trying to achieve out of it, and sometimes, you know, it does take a little bit of a conversation to actually sort of really work out what that looks like. And from there, what we will do, given the enormous breadth of the sort of the options that we have, from houses to, you know, flats in very central London at significant sort of capital values, or cheaper, higher yielding units in sort of regional markets, or city centres like Birmingham, Manchester, we can offer all of this, but not all of it will be right for you as an investor. And so what we're here to do is really listen, try and sort of help you work out what is right for you, and then provide you with options to that effect.
Yeah,
I think when we were talking about what we were going to talk about today, there are so many questions that we get asked on a daily basis, and we thought that it would be useful just to have a quick chat about some of these. Now, what I would say is there's also within the Zoom, within the sort of controls on the Zoom on your screen there's a Q&A box. So please do feel free to type some questions in there, and that you may have, and we'll try to get to them at the appropriate moment. I mean, Elliot, but maybe I've been talking for the last 5 minutes. Maybe maybe you could have like this first one. Is it better to buy? You know, again, we often will have a buyer come to us with obviously a fairly significant equity stake, you know, and they've got the ability to buy, you know, it could be one property in London, say at £600,000, or they could buy a couple or even three, perhaps spreading it around different locations. I appreciate there's no one size fits all answer, but what's your thoughts on this one?
I mean, first and foremost, it's down to person. It comes down to individual preference and individual sort of criterias, really. And so, and everyone, as you say, there isn't one size fits all, and everyone is different. You know, when we sit down and we sort of really drill into what you're looking to achieve from that property purchase and that side of things, is ultimately when I would come to the answer of, you know, buying one at 500 or two at 250. But as an example, and sort of moving forward, you know, if we get quite a lot of clients that say visit the UK a lot, and potentially would sort of like the best of both worlds and be able to have something that they can use occasionally when they're there. And that might mean that buying a more expensive unit that we work on like a short let Airbnb style basis, where it's much more flexible rental income, much more flexible rental timings, means that you could actually use the property yourself. It can be you know, for a couple of weeks a year or whatever it is, and you have that base, and then have it being let for the rest of the year. Or it might be, you know, it's a pure investment. You may not even want to go and look at it, you know, or visit the site or anything like that. And then we can look at other options that are dotted around that might be at a cheaper price point. From my perspective, and one thing I always sort of ask the question of, and is your risk appetite. Obviously, having spreading that risk and having, you know, two properties in different locations, and to having a balanced portfolio is always you know, a good angle to go, you know, to look at things. So it's horses for courses. There are plus and minuses to both, and it's just really what, you know, what works for you as an individual. And we can, you know, we sit there, we can go through that and analyze it, and, you know, look through all the options and really see which suits best, really.
I think also just one other thing to add there is that stamp duty sometimes forms a factor in this, in that if you're buying a property at £250,000, it's going to be significantly cheaper stamp duty than at £500,000, where if you're an overseas buyer buying an additional property, you may, you know, that stamp duty starts to become quite significant. Now, clearly, if the motivation is to buy that property at £500,000, I'll sort of work for you, then that's just something you have to sort of, you know, you just have to deal with. But if you're someone that wanted to spread that risk, you might end up paying slightly lower tax if you, you know, if you were to spread that around. But yeah, no one size fits all there. On the 1 bed and 2 bed thing, I think this is just something that, again, for me, assuming that we are talking about this from an investment standpoint, really fits. It should be answered purely by budget, in the sense that if your budget fits 250, you want to buy in Birmingham, well, that or Manchester, that's going to be a 1 bed. Whereas if your budget is 350, but you know, you buy a 2 bed because that's what it fits. The actual returns on a 1 or a 2 bed over a 5-10 year period are going to be virtually identical. You know, you might get a slightly higher income percentage on a 1 bed, but actually 2 beds tend to sell better into the domestic market later. So we are talking very minor things. On the cash leverage one, Elliot, I mean, obviously to some degree we've talked about this. And part of the answer obviously is the fact that actually interest rates aren't actually all that high on a long-term basis.
Yeah.
I mean, in my head, if this is a long-term investment, then an element of leverage is always going to be important. What are your thoughts?
Yeah, no, I mean, I think going back to, you know, looking at historic results, or the track record of the UK market from a house price perspective, that we can be pretty secure in the fact that we're going to see house prices increase.
Yeah.
What leverage enables you to do is build a portfolio a lot quicker, and a more substantial portfolio. Whereas tying all your cash into all your eggs in one basket, if you like, you know, it will slow that sort of ability down. And so therefore, you know, leverage is key to being able to sort of build that portfolio document and ultimately build that you know, your ultimate wealth, with the sort of, you know, the cash investment on one £500,000 property would pretty much buy you 3 properties from a leverage perspective. And with the fact that we're seeing interest rate, the fact that we're seeing rental amounts at a much higher amount than they were, you know, we're still seeing these and with interest rates higher, that we're still seeing it wash its face. Interest rates will start to drop. So it might be that, you know, if we went for leverage at the moment, you might just decide to go and say maybe a 2-year fix or something like that, rather than a 5-year. Something that gives you an option to look at something with a lower rate in sort of relative short term.
Something else that then, you know, if you're following property at all, you'll see that short-term lets are a big thing in the property world at the moment, and they are for us too. And clearly that sort of links to Elliot's question previously, because actually what short-term lets enable you to do, if done well, and if in a location that supports short-term lets, and some locations are much better than others, particularly ones that have either a strong business or tourist element to them, that can enable significantly higher rental income over the course of a year, which obviously in theory enables you to run at a sort of enhanced or more enhanced sort of cash positive level on a monthly basis, annual basis, and to offset that any mortgage interest rate increases.
Yeah. Well, just on that, actually, just the only comment I would make on the sort of cash versus leverage, where obviously we're quite highly pushing leverage there, is if again, down to personal circumstances and depending where you are in your time of life, but if you're purchasing the property from an income perspective, from an income play, so obviously paying cash then ultimately gives you a much bigger net income after them, and much less expense, and therefore gives you a really nice income on that basis, and that's equally important, and it just depends on what you're looking for.
Yeah, exactly.
So
it's an
it's
equally valid way
it's
of, yeah,
where you are
equally
in your time of life.
Yeah, absolutely. It's an equally valid way of doing it. And actually, the volume of cash purchases into the UK has increased dramatically over the last 12 months for obvious reasons, with the interest rates as they are. So if people are looking for income, it is the only way to do it logically.
And also, sorry, last one on this cash point. It's quite a big topic actually. But the other thing is, certainly if you're like many of our clients are in sort of dollar peg currencies and that sort of things, with the pound is still really not at the sort of strength it has been in years gone by, and yet still expected to sort of maybe become stronger. Getting cash into the UK at that point, and then maybe putting the cash in, taking advantage of an exchange rate, and then remortgaging at a later date again is a viable option, and it's just where your standpoint is.
We've already talked a little bit about other asset types. The one thing I would say, just from an other market perspective, is that so at RPA we historically have done most of our work in the UK. However, there are other markets out there that we like and can potentially help with. We will shortly, at this point, I would just like to mention, we will shortly be launching a property in Berlin in Germany as an alternative for people who are looking for, maybe they want to have euros available, or they would simply want a euro investment again as part of their wider strategy in the future. Berlin is a fantastic market. We will be running a webinar on this over the next sort of 3 or 4 weeks, so please do look out for that if you're interested. But with any investments, diversity within, diversity across your portfolio is key, and even within your property holdings, if you are someone that's been lucky enough to invest in multiple assets over the years, they shouldn't all be in one location or in one type of asset. That's something that's quite important. But this last one is, for me, is key. I mean, we've been inevitably, given this is our day job, we talk about this all the time, and the cynics out there would of course say, if these guys are agents, they're real estate agents, of course they're going to say now is the right time to buy. But I might surprise you and say that now is, in fact, the right time to buy. And joking aside, the reason for that is, the reason why I believe there is an opportunity in the market today is that, as it's quite an interesting time for us doing the job we do as agents. We are now, we're headquartered in the UAE, sitting here in Dubai. We have representation all over the world, and buyers and clients from all parts of the world. But the one thing that we are being offered today is we're being offered access to properties that 12 months ago we just simply wouldn't have been able to get access to, because the domestic market was effectively just eating them up before they got anywhere near the overseas market. My expectation is that whether it's 6 months or 18 months or somewhere in the middle, as soon as those interest rates start dropping even a little bit, as soon as we get even the slightest bit of positive news, domestic market will pick up dramatically, which will mean that these developers, these sort of the guys building the properties, they won't need the international market in the same way they do today. So what this means is that there is property that we're working on that quite simply we wouldn't have had access to 12 months ago. And so for our overseas buyers, for our clients around the world, there are some fantastic bits and pieces around. There's little deals available. There's little opportunities that honestly you just wouldn't get. Developers are also being hit by these interest rates. The construction finance is more expensive. They're buying less plots. There's less plots or less developments going through the planning process. There's actually now, in the last quarter, there were more handovers, more completions of handed over property than there were new planning applications going through. So that supply and demand deficit is just widening. So I think, you know, it doesn't particularly matter if the average price point for the UK drops 5%, 3%, 1%, whatever it might be over the next 12 months. If you can buy a fantastic asset in a good location, you know, we've already seen from the graph at the beginning, the Zoopla chart, that actually these assets are holding and even slightly growing 1%, whatever it might be, across the board from the data that was released on Monday. I think there is an opportunity today to actually pull the trigger and gain access to a type or quality of asset that either you won't be able to access it with the same degree of sort of, you know, or as easily perhaps in 12 months time. But you also, you know, if you can access it, it could be more expensive, or they might not be willing to throw in a parking space or whatever it might be. You know, there's an opportunity now that I think is worth seizing if you're in the lucky enough position that cash can be used, that you're not going to miss it, that you can tie it up in something, and particularly if you're comfortable and sort of confident enough to buy an off-plan asset. I think that's a very strong story there.
Exactly. I mean, just to sort of, obviously none of us have a crystal ball, and it's, you know, difficult to predict the market specifically, but if we're just looking back at historical evidence in terms of house price rising and that sort of things, if we look back to around sort of 2017, we had in the UK they declared Brexit. Now, essentially, what this did to the UK property market was that transaction levels just fell off a cliff. House prices are sort of very similar to now, sort of bumbled around plus or minus around parity by a couple of percent, but they had it just that was what it did, and it from 2017 to pretty much until Brexit was fully resolved and everything, the house prices sort of stayed around that level, and that was essentially because transaction levels stopped. People stopped buying. They weren't sure what was going to happen, so they stopped buying. And then in January 21, we obviously then had everything was confirmed, released, and we knew where we were moving forward, and the market went crazy. We had COVID, and it still went crazy through COVID. Now, essentially what's happened now is we've got higher interest rates. We obviously had the mini budget a year ago now, or sort of 10 months ago now. And people again have sat, you know, inflationary pressures and everything else like that. So people have again sat on their hands, and they're not in the market. They're not buying. When we see interest rates start to drop, those interest levels, those inquiry levels, people looking to enter the market will increase again and ultimately push up house prices. Because within the UK, you know, we have this, as Richard just mentioned, this chronic undersupply of property. We have a pent-up demand which sits there inactive for a period of time if they don't need to move, and then will sort of jump up back into the market as soon as they feel the rates are dropping. And therefore, now is as good a time as any, because you're waiting, in my view, and I think Richard agrees with me here, you know, if you wait 6 to 12 months, the property will ultimately cost you more. I mean, that's the bottom line.
Yeah, definitely. Because, and bear in mind, think about it as well, that rents have gone up so much, it's going to, even with higher interest rates, it's still going to be cheaper for someone to buy a property and put equity into that property and sort of own it rather than pay these interest rates. So as soon as we see even the slightest drop off, the domestic market is going to go sort of into sort of crazy mode again, I think. And what we need to do as overseas investors is get involved at a point when there is opportunity, you know, and the market has sort of not ground to a halt exactly, but has slowed. So I'm conscious that we've been on for 51 minutes now. I'm just going to, we'll just work sort of 2 or 3 things just to show you very quickly. New launches that we've got coming in the next few weeks. We've done a lot of work over the last 3 years in the Jewellery Quarter in Birmingham, which is probably the most desirable, definitely the most desirable part of central Birmingham. From here, you're a 5-minute walk into where, for example, Goldman Sachs, PwC, you know, HSBC all have their UK headquarters now. And this particular site is an amazing story in that we've been involved with this site right the way through from its inception, sort of phase 1 in 2020, all the way through to now, where we'll be launching the final phase in about 3 or 4 weeks' time. The interesting thing here, just to illustrate the rent side of it, is that when we first launched it, a 1-bed was being quoted at £825 a month. The most recent 1-beds have been renting for £1,150. £1,100 a month, depending on sizes. So it's been a significant growth. Obviously, prices have gone up in that time as well, but because of its location and the constricted supply within the area, you know, the long-term growth prospects are fantastic. Just before I just talk quickly about this, what I'd just like to stress as well is that we're just showing examples here. These are just current examples or upcoming examples of the things that we are working on. You know, what we're always trying to offer is a breadth of projects and products, both in terms of location. So this one's in London, in North London and Hendon, for example, through to Birmingham, Manchester, Leeds, slightly more kind of market town, more rural locations, and a different type, you know, different type of assets as well, and also different build periods. So some of them might be ready, some of them will be off plan. This is a great example of something. This was when I mentioned the yields available in London. This is what I had in mind earlier. You know, so this is units from approximately £400,000 for a 1-bed, 10% down payment now, and the balance on handover, which would be summer next year. And to get a yield of 6% in London, as Elliot said earlier, is astonishing. For anyone that's a seasoned sort of London investor, this is a fantastic time to be buying if you want to add to your portfolio. This is with one of the largest developers in the UK, so you know, ultimate security from that point of view. And then finally, the one that we will be launching next week for those partners and clients that we have who want income, pure income. They're not particularly worried about capital appreciation. They're not particularly, so they don't want to wait necessarily for that income. We are offering, well, we will be from next week offering a development in Leeds. It's 86 exclusive apartments to the RPA group and their clients. This is a short lets serviced apartments building, so it's essentially a mini hotel, if you like. Every single unit is £110,000. They are completed. It's been operating for well, as a short lets building for the last as a service apartment building for the last 2 years, but it's actually been in the market and operating and sort of being run for almost 2008, so 15 years now. So significant track record, central location. And the interesting thing for our buyers here is that we are offering a guaranteed 8% income for, I would say we aren't offering it, the owner of the short let apartment business is offering a guaranteed 8% yield for 5 years. So for anybody that is looking to get an income, this is something that something a little bit different that we've not sort of offered before, but in this particular market is something we're being asked for all the time. So if you would like further information on this, we will be launching this next week, and full information should be available from tomorrow. So yeah, we are almost an hour in, so probably time to wrap up. But just lastly, just to say, the idea behind RPA Group and what we're trying to achieve here is professional advice, professional level of sort of services across the board, whether that's simply identifying what's the right asset for you as an investor, all the way through to helping with mortgages, helping with the conveyancing process and the lawyers. We have a sister company, Brick Management and Lettings, who can provide that service, i.e. finding a tenant and all the rest of it. And in the future, we can, through Brick as well, we can offer the resales element too. So the idea is we're here to hold your hand. We're here to make it as easy as possible. You know, property sometimes does throw up a few challenges, as we know here, but we're here to try and sort of make that as reasonable and sensible and good an experience as we possibly can. But the key that underpins everything is the asset that you're buying. And I think that's where hopefully, we stand out in terms of what we can offer.
Yeah,
but yeah.
I agree.
So look, thank you very much, everybody. We'll wrap up there. You please do expect one of our guys to get in contact with you. We'd like to see whether there's, whether that you have any particular questions, whether you can help, or whether we can help you, I should say. And if you'd like a chat, please let us know. We are a very non-salesy business. We'd much rather give out good advice, and hopefully then when you trust us, it would lead to doing some business together. But we aren't, the key ultimately from our perspective is trying to understand what you're trying to achieve and potentially finding a solution for you. But Elliot, thanks very much for your time. Good to see you.
Thank you.
And we will we'll chat to everyone soon. Thank you very much.
Brilliant. Thank you very much, everyone. I hope you found that useful. Thanks.